the CCP launched a debt repayment quota of 10 trillion yuan on November 8th, but no stimulus measures, disappointing investors. The CCP launched a debt repayment quota of 10 trillion yuan on November 8th. U.S. media pointed out that the authorities did not introduce fiscal stimulus measures to boost the economy, disappointing many investors. The Wall Street Journal reported that Chinese retail investors and some economists had previously expected that CCP officials would announce a large-scale stimulus package on the 8th, especially after Donald Trump was elected U.S. president. Trump has repeatedly stated that he will adopt a tougher trade policy toward China, which could impact China's key economic growth pillar. Amid high expectations, various rumors about the stimulus quota circulated on the Chinese internet, causing China's stock market to fluctuate sharply. On the 7th, it was even reported that the authorities were preparing a 10 trillion bazooka-style plan, which included funds to stimulate consumption and support the housing market. However, the details announced by the authorities at a press conference on the 8th disappointed investors. In addition to the 10 trillion yuan debt reduction plan, the public had expected the Chinese government to also announce a fiscal stimulus plan, including issuing 1 trillion yuan in special government bonds to replenish bank capital and investing another 1 trillion yuan to prevent further declines in the housing market. Economists warned that the Chinese government's debt replacement plan should not be characterized as a stimulus measure because it did not increase government borrowing, nor could it reduce the high-risk debt of local governments. It was simply a debt extension. U.S. President-elect Trump will take office in January 2025. If Trump fulfills his previous promise to impose a 60% tariff on Chinese goods, the Chinese economy will face a heavy blow. UBS economists estimate that if the Chinese Communist Party takes no measures to offset the damage caused by the tax increase, the 60% tariff may reduce China's economic growth rate by 2.5 percentage points within 12 months. Andrew Tilton, chief Asia-Pacific economist at Goldman Sachs, said in a report on the 7th that Trump spent 2 years in his first presidential term imposing tariffs on Chinese goods. However, the process in the second term may be accelerated, potentially being implemented as early as the first half of 2025. Stock market influencer Shanghai Uncle was blocked. Did the authorities just throw him away after using him? At the end of September, the CCP pushed up the stock market and mobilized public opinion to lure people into the market. A Shanghai influencer who advocated for a stock market surge, known as Shanghai Uncle, became popular and deceived a large number of stock investors. Recently, the influencer's Douyin account was blocked. According to mainland media reports, on October 30th, Shanghai Uncle opened an account called Love in Late Autumn on Douyin, and the number of fans quickly grew to nearly 500,000. However, the account survived only 9 days before being blocked on November 8th. The first live broadcast, originally scheduled for the evening of November 9th, was also canceled. Many mainland media outlets reported that the blocking of Love in Late Autumn may be related to the authorities' crackdown on illegal stock recommendations and stock price manipulation on social media. However, the Douyin platform responded on the 9th, stating that because the real name authenticated person and the person appearing on the screen were inconsistent, the platform banned the account to combat illegal behaviors such as unscrupulous traffic. Some mainland netizens left comments criticizing Shanghai Uncle, calling him a stock neurotic, and saying he did a lot of harm to people. Some netizens also speculated that his account was blocked because the authorities had crossed the river and demolished the bridge, using him as a scapegoat for stockholders. A month ago, Shanghai Uncle predicted that China's stock market will rise to 14,600 points in 2026, and also claimed that for patriotism, he was willing to be trapped in the market, saying, "I am willing to do it too," fooling a large number of people into the market. After the stock market plummeted, there was a lot of criticism online. A video circulated online showed that some deceived stockholders went to the stock market salon on Guangdong Road in Shanghai to confront Shanghai Uncle. At that time, internal news on social media platforms suggested that, to lure more people into the stock market, the authorities instructed various platforms to give the green light to internet celebrities who advocated for the stock market to attract traffic. Netizens speculated that this was also the main reason internet celebrities such as Shanghai Uncle gained popularity so quickly. China's economy is worse than expected. Big changes ahead, a CCP insider reveals. Wang Duruo of Apollo.com reports that the Chinese stock market has stopped rising for several days, and selling pressure has emerged. At the close on Wednesday, October 9th, the Chi-Next index plummeted by 10.59%. The Shanghai Composite Index dropped 6.62%, and the Shenzhen Component Index fell 8.15%, dealing a severe blow to market confidence. Does this mean that China's economic difficulties have reached an unexpectedly dire situation? Regarding this, Lao Man, a well-known economic observer who once worked in China's land department and has a large following, commented that the background of this rescue can be analyzed from two perspectives. First, the central government's fiscal revenue, and second, consumption in major cities. Fiscal revenue has decreased by 30% per month, and consumption in major cities has frozen. Behind this is the sluggish real estate industry and the Chinese government's regulation of specific industries. While investment institutions initially applauded these efforts, experts familiar with China's problems, or those within China's industry and academia, have been more cautious about this rescue package. Looking at the top priority housing market, Stephen Roach, former chief economist at Morgan Stanley and a longtime friend of the Chinese Communist Party, once known as a Wall Street China expert, said that China's latest financial stimulus measures are impressive. However, the current fiscal plan still lacks clear details on how to effectively deal with the further decline of the real estate market. Take Country Garden, a giant in China's real estate industry, as an example. In 2023, it had around 36,000 houses that were completed but unsold, approximately 350,000 houses that were under construction but unsold, and 730,000 houses that were sold but not yet completed. This is the core of the problem and the most dangerous battlefield for ensuring delivery of completed buildings. According to Lu Ting, the chief economist for Nomura Securities in China, an estimated 3 trillion yuan, around 13.7 trillion new Taiwan dollars, of fiscal injection will be needed to solve this crisis. On the 8th, Ray Dalio, founder of Bridgewater Associates and another longtime friend of the CCP, said at an international forum that investment in China must be extremely cautious at present, as China seems to be fundamentally distancing itself from capitalism. Big things are happening there, including a debt crisis. They also have a capitalist crisis. The Chinese government is heavily in debt. Analysts, Beijing has limited room for fiscal stimulus. The Information Office of the State Council of the Communist Party of China announced that the Ministry of Finance will hold a press conference this Saturday, October 12th, to provide information on increasing fiscal policy adjustments, once again raising public expectations for fiscal stimulus measures. However, some analysts have pointed out that due to the heavy government debt burden, the fiscal stimulus space is limited and expectations should not be too high. On Tuesday, October 8th, the National Development and Reform Commission, NDRC, of the Communist Party of China did not introduce new fiscal measures as the market had expected, leading to a significant cooling of the Chinese and Hong Kong stock markets. On Wednesday, October 9th, the Communist Party of China officially announced that the Information Office of the State Council would hold a press conference this Saturday morning, where Finance Minister Lan Fuan would introduce plans to intensify the countercyclical adjustment of fiscal policy. Whether Beijing will launch a new large-scale fiscal stimulus package has become a key focus for public opinion both at home and abroad. Hong Kong's English-language media, the South China Morning Post, reported on October 9th that officials from the National Development and Reform Commission said on Tuesday that they would accelerate government spending, increase investment, and continue issuing ultra-long-term government bonds to support major projects. They also moved forward the 100 billion yuan strategic investment plan originally scheduled for 2025 to this year. However, some analysts have pointed out that the window to support China's economic recovery through fiscal expansion may be narrower than previously thought, as the government is already heavily in debt, limiting the space for fiscal stimulus. The report quoted Zhang Deli, chief macro researcher at Zhongtai Securities, as saying that considering the sharp decline in land transfer revenue, the largest source of income for local governments' actual income may decrease by 3.4 trillion yuan this year. Many analysts believe that given Beijing's concerns over local government debt, there is limited room for official fiscal stimulus. Zhu Qibing, chief macro analyst at Bank of China International Securities, bluntly stated that local government debt risks will limit fiscal expansion to some extent. The key for this year's fiscal policy is to relax fiscal constraints rather than increase stimulus. We should not have too high expectations for subsequent fiscal policies this year, he said. Ding Shuang, chief economist for Greater China at Standard Chartered Bank, also pointed out that by the end of 2023, central and local government debt would account for 56% of GDP, gross domestic product. If local government's hidden debt is included, the figure could rise to 100%. It is unrealistic to expect the government to expand fiscal spending when local government tax revenue is shrinking. On September 10th, at the 11th meeting of the Standing Committee of the National People's Congress, Minister of Finance Lan Fuan read out the Report on the Management of Government Debt in 2023 on behalf of the State Council. According to the report, as of the end of 2023, the statutory debt balance of governments at all levels across the country reached 70.77 trillion yuan. Among this, the national debt balance is 30.03 trillion yuan, and the local government statutory debt balance is 40.74 trillion yuan. Of the 11.14 trillion yuan in national debt issued in 2023, 4.16 trillion yuan was used to cover the central fiscal deficit, 5.22 trillion yuan to repay the principal of national debt issued in previous years that matured in 2023, and 1.76 trillion yuan to cover short-term national debt issued and maturing within the same year. It is worth noting that the above report from the Ministry of Finance only covers the scale and use of the so-called legal debt on the government's books, and does not mention the even larger hidden debts of governments at all levels. Previously, the Wall Street Journal reported in July this year that many Chinese cities have accumulated between $7 trillion, about RMB 50 trillion, and $11 trillion, about RMB 78 trillion, in hidden debt for economic development over the years. Due to the opaque financing methods, the actual total debt of local governments in China is unknown. Even the central government is unclear, with estimates suggesting that up to $800 billion of this debt is at high risk of default. A report by the research institution Rhodium Group pointed out that among the nearly 2,900 local government financing platforms evaluated by the institution in 2023, only 1/5 had sufficient cash to cover short-term debts and interest. Under the pressure of financial deterioration and debt, many local officials began looking for unconventional sources of income, even resorting to extreme measures such as exploitation and intimidation of private enterprises.